Good morning and welcome to the Orlando Real Estate Buzz. We got a lot to talk about this morning. Of course, the Fed had their meeting yesterday and held rates where they are, but I think Jerome has got a little something up his sleeve to help with liquidity. And then we're looking at some other items, which is we're seeing new home purchases, sales continue to drop, new home sales starts dropping as well. And then interesting, the investors in the housing market are starting to sell off a lot of their inventory. How's that all affecting the Orlando area? Still kind of stagnant. So again, welcome to Orlando Real Estate Buzz. I'm Brendan Rendo with the Homes in Orlando team at Next Home Neighborhood Realty. And let's get into it. Good morning. So, the first thing on our agenda today is we're going to look at what really came out of the Fed meeting yesterday. Of course, Jerome came out in his monotone, very blah demeanor, and basically said the same thing he's been saying for about the past 9 months to a year. The main thing we're seeing is that they feel that there still could be some expansion in inflation. They feel that we might be jumping up to the 3% range, which that of course is going to hold them back because they've really say they've got two points that they're trying to hit on. One is getting inflation to 2% or below is one of their mandates. And then the second one is to have full employment. So looking at both of those, employment's still sitting around 4.2%, but inflation has been a little sticky, sitting 2.3, 2.4, just over where they feel they need to be. So that's kind of their justification. Interesting enough, though, we're seeing one of the points that came out is that we're seeing slower economic growth. And the projections for GDP is only 1.4% for the rest of the year, which is rather low. And normally, if you see GDP projections going down, you would expect the Fed to loosen up a little bit, allow some more liquidity into the market, make it easier to get funds. And we're going to talk a little bit about what Jerome may have up his sleeve coming next week. So that's a concern. That really comes back to what we good old days of what we call stagflation. I was young during the 70s, and I remember that was a big term back then. We had high unemployment, had high inflation, and it just wasn't a great time. Stagflation is not a lot of fun. But the other big concern I think that they're weighing is what's going on in the Middle East right now, and that's oil. And even though oil is down to a relatively low value, between $60 and $70 right now, with what's going on in Iran and the rest of the Middle East, if they decide to cut off shipping, try and stop the oil movement, we could really see oil prices shoot up, possibly even double in just a few weeks. So I think that's one of their concerns because one of the driving things that's helped keep inflation down is the drop in oil prices, because the home prices have still continued to increase, and we've been offsetting them in inflation, in the inflation numbers with the oil price drops. So that's really kind of their big concern. And going into the rest of the year, what you've got, this is a projection of the 19 members, is right now we see 7 of the members saying they don't see any cuts coming this year. You got another 2 saying that, probably a quarter point drop. And then you've got 8 of them saying 2 possible cuts of both of 0.2 to 0.25%. So we've really got a split Federal Reserve Board right now. We got 50% really kind of saying there is going to be no cuts. We got 50% saying there might be cuts. So a lot of mixed bags, a lot of mixed things coming out of there. But one thing that was brought up, and wasn't a lot of attention paid to it, um, but Scott Bissett, the Treasury Secretary, testified on this last week and was asked directly about it. It's called the SLR. And what the SLR is basically what the banks have to keep in reserves in order to meet Federal Reserve requirements. And right now, if the banks are buying treasuries, they have to count that in their SLR number. And what had happened is last year, or back in 2020, the Fed actually took treasuries out of the SLR. So basically, what happens is, say you buy $1,000, and the bank buys $1,000 in treasuries, and they need to meet their SLRs. They had to keep $50 basically in their reserves. And in 2020, in order to increase liquidity during COVID, what the Fed did is says, guess what? Because it's the US Treasuries are so safe that you don't have to count that in your SLR number. So what that did is that helped actually inject liquidity into the system, which was fantastic. Well, on June 25th, in just a week from now, actually, the Fed is going to be meeting again, and the whole discussion is going to be on that SLR. The SLR is supplementary leverage ratio, just to let you know. So they're going to be meeting on the SLR and again talking about pulling out treasuries from that requirement. The reason why they're doing this is what has happened over the past couple bond auctions is you're seeing less and less foreign buyers into the bonds. And actually, the Fed came out yesterday and announced that the amount of funds being pulled out by foreign countries as opposed to coming in was a $14 billion deficit. So what that means is basically foreign investors, instead of being a positive influence on funds coming in to buy treasuries, they actually pulled out $14 billion. And that's the second time in a row now that we've had a negative number on foreign investment going into treasuries. So that's unsettling in the bond market. And that's why we haven't seen bond rates come down. Everyone talks about, oh, cut the Fed, cut the rates, help mortgage rates go down. No, that's not it. That is a misnomer. It has been a misnomer for years. It's not the Fed rate that determines the mortgage rates. It's really tied more to the 10-year Treasury. And right now, that 10-year Treasury is just sitting there, just flat as can be, sitting in that 4.3 to 4.5 range. There's nothing that's pushing it down. And what they're hoping to do is by removing the treasuries from the SLR is they're going to open up liquidity, and the banks are going to take that reserve that they would have had to have for their treasuries, which they hold a ton of them, is turn around and actually reinvest that, make up the difference that the foreign market has pulled away from U.S. treasuries, and make it up with the domestic market. That is the whole goal, plain and simple. So if we see this, and they do waive the requirements of the for the SLR with the treasuries, I think we may actually finally start to see a little break in the bond rates that we haven't seen in quite a while, because that extra liquidity, the banks hopefully will take that money, not so much lend it out, but actually just put it back into treasuries, open up a large amount of liquidity, and actually push bond rates back down. That's really the goal of the Fed with removing the treasuries from the SLR. So June 25th could actually be a big day for bond rates. And so keep an eye on that, because that gets approved, I think we'll actually finally start to see the bond market react and the rates on the 10-year, because we're going to have an injection of a large amount of liquidity, actually start to push those bond yields back down, which would be good for everyone because, of course, that's our national debt. The lower that is, the less interest we have to pay. So that's one of the big things that we're looking at right now and keeping an eye on for everything. Then other items we have going on in the market right now is, even with all the incentives that are going on with the builders, new home purchases are down again. And we actually saw about a 4.5% drop year over year in May, which was better than what we saw in April. April had a 9% drop in in the um in the sales year over year in new homes. So not not quite as bad as April, but not great. We don't want to see that year over year drop. We want to see a continuation of growth. And it's very surprising because right now the incentives from the builders, if you're looking to buy, there's a lot of incentives from builders. I mean, they are offering um, down as low right now as a 2.99% interest rate in a 2-1 buy down or a 3.32 buy down. They're actually buying down interest rates flat for flat 30 years. Flat 30 years, they're buying down as low as 5%. So basically, you can save about 2% on your interest rate if you go with certain builders right now. And they're also, I got an email from Lennar yesterday, and they on some of their townhomes, they were offering a $77,000 discount on the sales price, plus the 4.99% interest rate. So the incentives out there are fantastic for new home buyers. You just got to know what they are and be able to negotiate them. Now, interesting enough, they're trying to incentivize us as realtors. And a lot of you know that we had the big lawsuit, the National Association of Realtors settled last year. So here's the thing: is if you and I have an agreement that I'm going to be paid 3% as your buyer's agent, and the builder offers me 3% plus a $5,000 bonus, I can't take that bonus. That is actually against the settlement rules. So if you want it, I'm happy to throw it in. So take advantage of it. If I'm not allowed legally to take these benefits, we shouldn't be letting them just be thrown away. We should put those into your package so that you can take full advantage of it as well. That's just a little side note of things that have happened because of the recent settlement. The other thing we're seeing is our housing starts, because it's getting so slow, and the builder confidence is just in the toilet. I mean, it is just horrible right now. Um, Even though you do see here in Orlando, you see some new development going here, new development going here. And what I don't understand is these prices, they say starting at 400,000, 500,000, $600,000. It doesn't fit 95% of the market. It really does not fit 95% of the market. That's why I'm actually working with a home builder right now, where we're trying to figure out how to build homes in that 250 to $300,000 range, because that can actually fit maybe about 50, 60% of the market that's out there. But it's gonna be a smaller home, but it's your home and you're not renting. So our whole goal is to be able to provide people homes that are less than, or at least not more than, the what you're paying for in rent right now. So as far as housing, everything is moving, quite honestly, I feel, in the wrong direction right now. It's a very soft market. And I mean, even investors right now, we saw this for the first time since 2001. We are at the highest level of investors selling their homes that we've seen. They This past year, we've actually saw 11% of the homes that were sold were investor homes. And for the first time in a long time, investors are actually selling more homes than they're actually buying. What does that tell you? It tells you that they feel, if I'm an investor, I've the market has peaked for me. I'm not gonna be able to get any more out of the home. I could actually see a decrease in the value of my rental property. So what do I want to do? I'm going to sell now. I'm going to maximize my return on my investment. So that tells me a lot of where, because investors are usually pretty savvy. Um, it tells me where the market may continue to head for maybe the next 6 months to a year. If we continue to see the investors pulling out and selling their homes, it tells you that it's a very, very soft market. 'Cause investors, if home values were going to continue to grow, investors aren't going to sell their properties. They're going to want to continue to get that additional equity in their home. But it shows that they feel that we've kind of peaked. We may be pulling back a little bit as well. So a lot of interesting items going on showing that we are in probably for at least the next 6 months, um, unless the Fed, the change in the SLR actually makes a big difference. I'm hoping that with the change, which I really think they're going to do, Secretary of the Treasury, Bassett, has been pushing for it very strongly. Um, that it will increase the liquidity into the bond market, and that's going to give us some rate relief that we need. I think we need to get down to 6%. If we can get down to 6%, I think we're going to see a lot of buyers come off the sidelines. Um, and until we have that, you're just seeing so many people sitting, waiting, trying to feel it out. Um, But like Redfin came out with a report that says we were in the biggest gap that we've seen in a long time between what a seller feels his house is worth and what a buyer is willing to sell at. And that's roughly at about 9%. And when we get into the numbers for Orlando this month, you're seeing exactly that. In that the original list, which is the number I really like to work off of, the original list to sales price, we're sitting at 92.6%. So it's not quite 9% as we may see nationally, but you're looking at roughly, was that about 7.5% of the original list price. So there's a big discrepancy there. So, and when you're looking at, what is that? If you're looking at $400,000 house and 7%, God, my math is awful these days. 21, was that about $28,000? About off a $400,000 house, we're looking at about $28,000 difference between what a seller wants to sell it at and what someone's actually willing to buy it at. That's a huge, huge discount. And you can see it up here. And when we actually look at actual numbers, is on 250, we're seeing about $23,000 discount. On 250 to 300,000, $30,000 discount. Then you get up here and you look at the 400 to 500, where majority of our houses are. There you go. $24,000 off the original list price is what we're seeing on the majority of these sales. That's a big number. That is a really big number. And you're seeing average days on market holding up there at 67 days. That's why when I look at things and going over numbers with my clients, is first thing I'm looking at is, what's the original? Have they cut the price? How long has it been on market? Because you can look through the data and see that, well, a lot of home sellers wait 30 days to drop the price. Then they do it at 45, and then they may do it at 60. And you've got the numbers to be able to negotiate that, hey, I know that this could be what type of discount I can actually generate or be comfortable with asking. So that if a buyer's saying, well, I'm not willing to do that, but I'm willing to go in $20,000 less on the initial one, you can't tell them, no, I think that's too much. It's like, okay, that actually kind of makes sense based on the numbers within this range, within this subdivision. Yeah, that's actually what we're seeing overall. And that's why it's so important to watch these numbers on a weekly basis. So you get an idea of exactly what's going on in the market. And you can see that, wow, Orlando is really, even though we're at 5 months, people say, oh, that's a balanced market. It's not a balanced market. This is a buyer's market right now. If you're a buyer, it's your time. The interest rate may be a little bit higher, but that's something you've got to look at and say, well, what if I can get the seller, if I'm generate a $24,000 discount, what if I, instead of taking the whole discount, I say to my seller, hey, I want 10 grand of it as a closing cost credit because I'm going to use that to buy my interest rate down. And that's where your relationship and having a good loan officer helps you as well. So those are the things you really, really want to look at. And if you think the housing within the homes is a buyer's market, wait till we look at this. This is the condo market. We right now have 8.5 months of inventory for condos. That is a huge, huge number. And look at the original list to sales price. We're at 91.75%. So basically 8% discount off the original list price. And look at this right across the board. Under $250,000, they're giving about a 10% reduction off of the original list price right there. Up to $250,000, on average, 24,500. That is 10% off the original list price. So you've got room. Like as I mentioned last week, I've got a client who has a property in Davenport where last year we had 20, 25 homes or condos on the market. Now we're up to, I believe, 55 homes, and they are dropping prices left and right. You're seeing where we had gone from roughly 230 is people are offering their condos now at $170,000. That's a $50,000 drop in price. That's unbelievable. So the condo market, I mean, if you're looking at a condo, you can really get some deals, but just realize that the HOA fees basically have tripled since 2 years ago. And that's all due to the law that Florida passed. I don't think even with the one that's going into effect here in July, that it's going to allow any reduction whatsoever because they still have to build up those reserves. It just gives them more time to actually meet the requirements that the state has set for the reserves that need to be there. But that's it. I mean, it's turned into a full-fledged buyer's market right now. And like I teach my clients, if you don't like it, walk away, because we will get callbacks saying, oh, well, we may be willing to do this now. Because there's a good chance that we're going to be the only people looking at a house. So know your numbers. That's why we come to you on a weekly basis to show you, hey, this is what's going on nationally that's affecting us locally here in Orlando. And here's your Orlando numbers. Take advantage of them. If you got questions about them, we can actually drill down into subdivisions and actually show stuff by subdivision. That's the whole, that's what we do when we're preparing comparable sales for our sellers. It should be the same thing for a buyer. We should be pulling within that subdivision all the comparable sales, looking at all the pictures, going through, showing you that, hey, this house sold for this house sold for this one had this had this upgrade, this didn't have this upgrade, and realize, hey, this is what we can do, and this is why we can be this aggressive in going after this house. So if you have any questions, always feel free to reach out. And thank you again for joining us here at the Orlando Real Estate Buzz. We'll be here every Thursday at 11 o'clock. And please, if you're on YouTube, or Facebook, please like and subscribe. Take care and have a wonderful weekend. Bye bye.